Well, I have to say, David, we don't think they have the money. I mean, you've got a number, something like 53% of the people in the United States can't even round up $1,000. So you're in a situation where I don't think there's going to be any stimulus to help them because of where the federal government, they're in a hole right now too. If you look at our deficits this year, they're exactly twice what they were for the whole year last year already.
You ever think our economy's brighter than Times Square on New Year's Eve? Plot twist. We might be heading for a not-so-happy new year. Enter the sage of our saga. In this interview, Ted Oakley reveals economic insights which the government doesn't want you to know. Ted Oakley is managing partner and founder of Oxbow Advisors. Think of him as the Dumbledore of dollars. He's seen the market's past, present, and murky future. According to Teddy Boy, if you're waiting for a market Cinderella story, midnight might have struck already. Now, before we get into the juiciness, a teeny heads up for our beloved Token Nation. This ain't your average financial advice hour. It's more like an economic variety show. Enjoy, but maybe don't bet the farm on it.
Why is the consumer, the American consumer, still under pressure, Ted?
Well, one of the reasons is the two big primary drivers, which are energy, obviously oil at $85, and real estate. Real estate's a lagging indicator. So what happens is the negative effects of that are just now starting to show up, where you're starting to see some reduced rents on new things. But what happened is that those two things hang in there to keep CPI really fairly high. And you have to get past those a little bit. And that whole thing, by the way, drags down demand. I mean, you have to think, at least I think, that when you have August CPI come out, which is next week, that you're going to see a higher number, just because, if nothing else, because of oil. It had a big move in August, and I suspect that that's going to go higher. And so we'll see if that happens. But I think people are missing the point. If you just look at general demand, go look at what's happening. People are buying less, and they're buying less of things that are interesting. They're buying less appliances, furniture, things that you think, well, housing is great, but it's really not. That's what I'm saying. They don't have the money. And so those are things we watch closely. Our deficits this year, they're exactly twice what they were for the whole year last year already. And so if you look at that and the interest they're having to pay, there won't be any stimulus probably coming out of Congress, I don't think, with a split Congress. But I'm just saying the people out there don't really have that much cash, and they burn through what they had. I even see, it's crazy, but I see people doing home equity loans, at 9.5%. And I'm like, what are you doing? Well, the reason is they need the cash. And that's really all you can say. That this whole Big 7 or Big 10 stocks, they're what everybody owns, and they own a lot of it. We don't own much of it. Not saying we don't own any, but we don't own enough to hurt us. And so I think what's going to happen is these people that are concentrated in those areas, I think it comes back to haunt them, because when you have a market downturn, they go after the big ones. And, that's how it always happens that way. And they go after them in the end, not in the beginning. They look okay in the beginning. And then as the end comes around, people are like, everybody's in the same thing. So when they go to really, really sell, they sell the biggies. And I think that's what will happen this time.
For all you stock enthusiasts, here's the tea. Each time you consider cashing in, inflation's right there, ready to photobomb your profit selfie. Remember cozy, low inflation nights by the fire? Well, the logs are damp now, and if the Fed even thinks about catching some Z's, your dollar might need a nap too. And a bit of international goss. Our move on Russia might have had the world reconsidering their dollar commitment. Did we just get ghosted?
Why don't you buy NVIDIA now? Why aren't you jumping onto the whole AI craze or the next big trend in tech? What would your response be?
Well, I can only tell you from experience. And first of all, I've tried a couple of AI sites, and I have to tell you, I've gotten back some just flat out wrong information, okay, of things that I already knew. I just asked a question, and of things I already knew, and then I'd see, produce case law that didn't exist, all sorts of things. But it reminds me of that period 3 or 4 years before 2000, and all of these companies would come public in that 3-year period, and all they had to do was put .com behind the name. That's it. That's all they had to do. They didn't have to make any money. Everybody was like, this is going to be, this word was the most talked about word I ever heard, new paradigm. And I had that told to me so many times. And it was, the internet changed, but it wasn't the way they thought it would. It was, we lost all of those companies, or most of them. And the ones that survived are new companies that came along afterwards, were the ones that really did well in the space. And I suspect that's what will happen with AI. I suspect that this idea that every company is going to be rejuvenated with AI is not true. I think they want to be on that bandwagon right now, but that's because it's popular. So we'll just have to see.
In the history of the S&P 500, there have been more up years than down years. And so one argument is just go passive, buy the index, leave it alone, and don't worry about it. In 30 years, you'll most likely be up than down. Could you evaluate that strategy?
Well, I think it's an okay strategy, but here's the problem you run into. And this happened to me when I was early in the business. From all the 70s and up through 83, 84, market didn't go anywhere. It just went up and down 20% for 15 years. Same thing happened between 2000 and 2012. If you just bought the index, by the time you got to 2012, you made 1% a year. People, they want to believe that's okay, and it works out over a long, long period. But when you start talking to people about, hey, don't worry about it, it's a 20-year deal or a 30-year deal, they blank out on you. That's not real to them. They want to know what's happening next month or next year. But I would say this, that's one of the problems you get into. And the other problem is this, and I just saw this chart from JP Morgan, by the way, 20 years of investing, 2000 up through 2002 through 21, and you got all these things that made money. Average investor makes 3.4%. The average investor, came from Dalpart. And so if you look at that, you'll realize that what people say and what they do are two different things.
Let's pivot, shall we? AI's the new buzzword. Remember the internet's just a phase crew? Yeah, they're in the Miss the Boat Club now. And Ted's betting AI's the next big wave. AI's the future, but if you're jotting pointers, consistency and collaboration are the names of the game.
To evaluate if a company is worth investing in.
Well, that's not what we do. I'm not saying what they do is wrong for them. I'm just saying what we do is we look at intrinsic value, which is basically how much cash flow present value I have on what I'm going to be having in the future. And I will say this, I don't care whether it's private business or public business, whatever, cash flow is king. And the way you get cash flow is by having more sales growth, selling more product, producing more profit, and that sort of thing. So I'm not on that same page with those people like that. And by the way, that worked really well during the free money stage. I do not think that will work as well during times when money's tighter. And I think that's where we are right now.
A price for peace of mind, Ted.
Well, I'll tell you why. Because if you have a big year in the market, and let's just say the bond market's up, 30%, and you're only up overall, if you take all your investments, you're up 16 or 17 because you have a mix of things, people will feel like they've been slighted. But what happens is, I find the biggest problem for anxiety for people is when they're not balanced, and I mean both directions, okay? That's when they're too conservative, so we have no growth. And so all of a sudden you have this major uptick in the market for 2 or 3 years, and they have this unbelievable anxiety that I missed the whole thing. I can't kick in myself because I didn't buy anything. And on the other side, you have people that are so optimistic that they keep everything there. So you go the other way, and it's beating them up so badly they have to come out of the market, and they get beat up on that side. And when I say balance too, I'm including real estate, and I'm including cash, I'm including private businesses. I just think if a person will look at the whole spectrum and not just say, okay, I'm gonna do everything to try to beat the S&P 500, and you might for a couple of years, but then there's times when you won't. And so if your objective, and I think it should be, if your objective should be to keep your buying power up the rest of your life and be able to meet all the things you wanna do till you die. And that's, to me, the right way to invest. And that means probably you're going to hold some cash. It means you're going to hold some real estate. And there'll be years when you won't do as well as everything else, but you have peace of mind because you know what? When you go through a downturn, you won't get blown up either.